Part of the debate over the fiscal cliff could have a big effect on nonprofit organizations around the country. The Obama administration reportedly pressuring nonprofit leaders to get behind the president's call for higher tax rates on those who make over $250,000 a year. But it may be a harder sell than the administration had thought. Tonight we investigate what is at stake in Reality Check. Well, the situation comes down to closing tax deductions for those who make over $200,000 a year for single, $250,000 for married couples. Here's how the charitable deductions tax break works. Right now, people who itemize deductions are able to deduct their charitable contributions at their maximum marginal tax rate. So, for example, if someone is in the highest tax bracket, now at 35%, they give $100 to charity, the donor then saves $35 in taxes. What President Obama is proposing is capping the value of deductions for individuals earning more than $200,000, families $250,000, at a 28%, regardless of their tax bracket. Using the same example, if someone in the 35% tax bracket donated $100, their deduction would be capped at 28% or $28, meaning the donor would save only $28 instead of the $35. So this would include deductions also for mortgage interest and state and local taxes. Well, nearly 40 million people a year claim the deduction on individual tax returns. The backlash to the move, though, as you can imagine, is largely coming from charities who say that if wealthy donors have a reduced tax incentive, they will then donate less. Now, that is why more than 60 nonprofit groups have spent at least $21 million lobbying Congress and the White House to preserve the charitable giving deduction. And that includes the YMCA of Greater New York, the Boy Scouts of America, and the Philanthropy Roundtable. They've all hired D.C. lobbying firms. Now, it is worth asking, is this $21 million that's been spent on lobbying money that was donated for the less fortunate? It would appear so. But the charities say that the lobbying expenses are a sound investment, given the money that's at stake. After all, Americans donated nearly $300 billion to charity last year. So to the question, if charitable deductions are limited, does it mean fewer Americans will donate to charity? The answer to that is, well, no one really knows. It's very possible that Americans will give less, but it's also possible that wealthier Americans would still give the same amount because they still get some tax deduction. But what this means for you is that the argument that these tax loopholes need to be closed to make the wealthy pay their fair share doesn't quite seem to fit here. Because even if you leave the deduction for charitable contributions completely alone, the money doesn't stay in the hands of wealthier Americans. That money is being redistributed by those Americans to charities to use it to help low-income Americans. Now, do some charities waste money? Well, yes. Spend it poorly? Yeah. Even at times embezzle or steal money? Yeah, they do. But so does government. The difference here is that when you give to charity, you get to choose what organizations you support and decide which ones to avoid. When government takes your money, you really have no say in how they use it. And that is Reality Check. You can find the sources for this story posted on our website at fox19.com. If you'd like to make your voice heard, you can head over to my Facebook page. You can find it by searching Ben Swann.